Good morning, everyone. You are watching a live market outlook for Friday, 16th of December 2011. The brief break in the markets after heavy losses, it seems to be over as euro started again pointing lower. However, yesterday's supportive tone came from the unexpected raise in the unemployment fall in U.S. unemployment and stronger than expected rise in the regional factory activity, as well as some better than expected results from FedEx Corporation improved the picture of the U.S. economy, and they pushed the dollar immediately down, which was the main reason of the recent recovery of euro and the sterling. However, the pair is still pointing lower as the part of the broader downtrend, and the fears of a further increasing of the current European crisis are keeping the pressure on the single currency as well as commodities, as the gold and the crude oil remain in defense and approaching the critical levels last time seen a couple of months ago. From today's highlights, the most important comes from Fitch, that the third biggest of the major credit rating agencies downgraded some leading world banks such as Goldman Sachs, Deutsche Bank, and 5 other large banks based in Europe and the United States as they increase the challenges in the financial market. Fitch also cut the long-term ratings on Barclays and Credit Suisse by 2 notches to A from AA-. The agency cut by 1 notch its long-term rating on the Bank of America and BNP, Citigroup, Deutsche Bank, and Goldman Sachs. The financial market challenges the banks face result from both economic developments as well as regulatory changes. Fitch said in an announcement issued shortly after regular market hours in New York yesterday. In a separate announcement about the downgrades of Citigroup, Fitch cited the policy momentum against using taxpayers' money to support banks during a crisis. The Fitch actions follow downgrades by Standard & Poor of several major banks at the end of last month. S&P moves come as a part of an overhaul of its rating methods to incorporate lessons learned in the financial crisis. Moody's also issued downgrades recently. The main threat for the Eurozone is now the already announced possible downgrade of several Eurozone countries, as well as in addition to the current downgrade of the banks that might have bigger consequences for the whole Eurozone and drag the zone into recession. The next meeting of the Eurozone members is due at the beginning of February, when they will be discussing further steps to prevent the worst scenario and try to pull out the Eurozone out of recession and to tackle the crisis in a proper way. However, the bad thing comes from UK's avoiding to enter the current agreement that all other 27 countries agreed in the new fiscal policy and the more controlled, actually, fiscal policy of the countries. That's the only way to prevent a catastrophic scenario for the Eurozone as a group of 27 European countries. From today's calendars, a few things due to release. Eurozone trade balance due at 10 o'clock p.m. Forecast is drop in the surplus to 1.3 billion compared to the previous month surplus of 2.1 billion. Another negative expectation, while from states, monthly CPI due at 1330 is expected to grow by 0.1% compared to the previous month contraction by minus 0.1%, while core CPI on monthly basis is expected to stay unchanged at 0.1%. A few speakers from FOMC, Evans and Fisher, are due to speak at 16:15 and 1700 GMT, and that would be all from today's calendar, as Friday, usually, unless it's first Friday of the month, doesn't have many indicators to be released. However, end of the week might signal some profit taking, and we might see some stronger action in the market. It seems that the dollar is back, attempting to get back into strength after recent 2 days corrective mode. That would signal a further weakness of the stocks that recovered yesterday on the positive data from US, and would put more pressure on the euro and the commodities such as gold and the crude oil. And now we are going to take a look on the charts and see the latest past 24-hour movements. As we can see, euro is still in the corrective consolidative mode, with the hourly studies slightly turned higher and pointing still higher. However, the 130.63 high of 14th of December, 2 days ago, is still intact and resisting the current attempts higher, as several attempts stalled at 130.42, 130.47 and 130.43, so keeping the upside intact for now. Overall picture on euro remains quite bearish, with the 20 days simple moving average and on 4-hour chart currently at 130.39, limiting the upside for now. The likely scenario would be further extension lower, as seen on the daily chart, as studies are quite negative, and the 20 days moving average on the daily chart currently at 133, maintaining the current negative structure. The immediate focus is critical low at 128.72, which is the low of the year, posted on 9th of January, below which would open way for further retracement of the longer-term uptrend from 118.75 to 149.38 high of 2011, with the 76.4 Fibonacci retracement and the low of 22nd of August 2010 at around the 26 zone to come next in focus in case of break. Immediate support at 129 zone is the bear channel trend line and floor, below which to open our key level at 128.72. On the upside, as mentioned, initial barrier at 130.63, ahead of 131 and 131.50-60 zone, while lift above 132 and 132.35, which is the high of 13th of December, might improve the near-term outlook and avert immediate downside risk in favor of stronger correction. However, the broader outlook for euro-dollar remains firmly bearish. Cable is still in the corrective mode of 154.07 low, after breaking the previous strong support and the previous low at 154.22, hitting the levels last time seen at the beginning of October 2011. Regain of 155 handle extended so far to 155.40, briefly breaking above initial resistance at 155.30 zone. However, still to break 155.60, which is the main trend line resistance and the channel ceiling of the broader channel from 157.68 high of 8th of December, break of which is required to confirm the near-term bottom and the open way for a stronger correction, with the Fibonacci levels to watch in case of break. This is actually currently testing 38.2 with the 50% Fibonacci on a break to test at 155.87. Only break above 156 handle and sustained break above 156 would signal bottom at this point 154.07, and look for a further upside test of 156.30, which is 61.8% retracement, and 156.60 zone, previous highs of 9th of December. On the downside, loss of 154.07, 154.00 to open way for 153.26, 28 lows of end of September, ahead of critical level at 152.71, low of 6th of October, which is also the floor of the broader range from September 2010 until now. So it's a longer term range that held the downside intact. Break here would signal significant weakness of the pair. Dollar yen maintains a near-term positive tone despite breaking below 78 and 77.90, the main trend line support, as the dips extended down to 77.72, just ahead of our key supports at 77.63 and 77.50. Holding above these two levels keeps the hopes for a further extension higher and possible test of 78, 78.15 highs to extend the higher and challenge 78.27, 29th of November high. The 1 hour studies are turning positive with 20 days moving average at 77.87, currently maintaining the latest advance. As mentioned earlier, the dollar seems to be regaining strength again after yesterday's shock from the positive data, but it seems that it's regaining strength and maintaining its longer term uptrend, so we might see the test of 78, 78.15 in the short term, in case that the latest higher low at 77.72 holds the downside. On the downside, loss of 77.50 would be bearish again, and look for test of 77.12, 77.00, and possibly to extend further to the downside. Dollar Swiss extended its pullback after strong rally through 95. Handle extended the gain so far to 95.45. A loss of initial supports at 94.30 and 94.00 has so far tested 93.75, which is approximately previous highs of 13th of December, and just ahead of 38.2 Fibonacci retracement of the broader uptrend from 90.69 up to 95.45. Negative hourly outlook might keep the focus on the downside now, as long as 95 handle stays intact, with initial resistances at 94.30 and the 94.70 zone. However, break above 95 at this point is required to resume the uptrend. Otherwise, there is a risk of a lower top and possible further retracement of the latest up leg from 90.69, with the immediate risk at 93.63, the 38.2%, and 93.40 low of 13th of December, ahead of a strong barrier at 93.00, loss of which where also comes the main bull trend line, approximately there at 92.70. This might be risky in the longer term of confirming the top at this point, and the open way for a stronger reversal. On the upside, as said, the 95.00 needs to be regained to refocus 95 and resume the broader uptrend towards 96 initially. The gold is, this is crude oil is in defensive, loss of our strong support at 95, and break below the 200 days moving average is currently being supported by 55 days moving average on the daily chart at 93, currently standing at 93.10 with dips seen to 93.30. ability to hold above this level might see some development on the upside. However, the studies are still negative, and the loss of momentum on the daily chart is suggesting further weakness after possible corrective action. 95.77 200 days moving average now on daily chart now is offering initial resistance. Ahead of first comes 95, previous strong support, now resistance, and then 95.77, and likely to hold the upside for now in favor of a stronger reversal, with the levels to watch below 93.75 at towards losses towards 38.2 Fibonacci retracement at 92.50, and then levels next area of stops of supports at around 91.00, 90.82. On the near term, 4 hours studies are quite negative at this point, but oversold conditions might see some corrective action. As mentioned earlier, 95 offers initial resistance, with the 20 days 4-hour chart moving average currently at 96.90, maintaining the downtrend. Gold is currently taking a break after heavy losses through some significant supports, losing the last 1600 and 1582, and extending so far to 1560, just ahead of our key support at 1532. Loss of 200 days moving average at 1620 is further weakening the structure, and the likely scenario would be extension of the broader downtrend from the record high at 1920, with the loss of 1532 to open way for further extension, and possibly to focus 1500 and 1480 on a break. On the short term, corrective action sees the hourly study still in a positive mode, with the clearance of 1600, our initial resistance, 1595 seen so far, required to signal stronger recovery. However, this is seen corrective as long as next level at 1685, 1700 stays intact, and likely scenario would be lower top somewhere above 1600 or at 1600 before the bears reassert and push the prices lower towards initial and strong support at 1532.